That's why Bitcoin is long-term I'm bullish. But right now, the biggest bridge that we have to cross is, as Dave mentioned, we're tilting towards this recession. What typically happens in recessions is the Fed cuts aggressively. This is not an opinion, that's a fact. Is McGlone saying what we don't want to hear, or is McGlone saying what he really thinks and warning us?
Hey guys, welcome back to Library of Wealth. As the U.S. economy steers towards a major recession, the first since the launch of Bitcoin in 2009, Bloomberg Intelligence esteemed senior macro strategist Mike McGlone is warning crypto investors that the worst is yet to come. McGlone says it would be wise to limit exposure to risk assets as volatility is likely to surge. McGlone points to the declining price of cryptos in the second quarter as a sign of skepticism that the stock market can sustain its next bounce. He also believes that the Fed remains a strong headwind for Bitcoin and crypto prices, and the rallying stock market and watchfulness over central banks could be a major obstacle as well. McGlone takes a firm stance that adding rising rate hike expectations to a climbing stock market may put a ceiling on crypto prices in the coming months. He warns that since the markets are leaning towards more rate hikes in June, this could signal a potential lose-lose for risk assets like Bitcoin. Let's get right into the latest interview with Mike McGlone, as he gives his crypto and stock market prediction for 2023. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The key thing I keep watching is every time I look on the Bloomberg terminal, I see we still have these bars that show they're going to be hiking in the July or June, July meetings. And I look at that and like, there's really no chance I see of things like an end to this deflationary forces we're seeing in commodities. Bloomberg Commodity Index is down almost 30% on a one-year basis. We're seeing a little bounce in crude oil today, but I don't really see an end to that until you get well past an easing cycle. And we're not even started yet. So we heard trickling every day now. We've seen trickling downward in China, which has been my expectation for years, but not doing very well. In the shorter term, like the key thing is about OPEC plus meeting cuts this week. And it's silly how people who are still trying to play that bullish game in crude oil, yet it's been in bear market since 2008. And I did say 2008 because that's when it peaked and last year made a lower high. And people keep looking for that old scenario by looking at this old supply side that they still matter, but less so every day. And so we're getting a bounce again in crude oil, and that's what's been happening. We get a bounce on the OPEC cuts, and then it goes back downward to trend. So I see crude oil right now, it's pushing towards 75. It's still going to head towards 50. Natural gas has already done the equivalent. Commodities always go towards their cost of productions in the long term, particularly when you've seen kind of dicey inflation or economic demand, which is not so great. So they always go towards cost of production. And the key thing I'll end with that's so important we need to point out is cryptos are showing divergent weakness now. This is on a quarter, on the whole quarter now. Q2, the Bitcoin's down 6-7%. Bloomberg Galaxy Crypto Index is down about the same. And the Nasdaq's up about almost 10%. That's a sign of divergent weakness. Now, people keep saying the correlations have broken down. I'm like, yeah, they're breaking down the wrong way. The fastest horse in the race is warning everybody, warning us that there's a problem. I know I have to say this very carefully on this program because we all have to listen to ourselves and our views. Is more McGlone saying what we don't want to hear, or is McGlone saying what he really thinks and warning us? And this is one thing we always have to be careful. I add it myself as a trader and ex-trader, not like Dave who still runs money and you. I'm just out to point facts of what's happening. And I have to sometimes, I know in 2018, a lot of crypto people get very upset with me for pointing out facts and my views, but this is a fact in crypto space. My sense is most people think the worst is over, yet there's a good chance it might not be. For 40 years, we've had a blip, we're heading back down. But there's key things sometimes that Dave and I have learned that's inherent in what we do, and that is absorbing, studying, and listening, and reading and studying headlines 24/7. And it's something I've been doing for decades. And when I just saw that headline this morning, big U.S. banks face 20% jump in capital requirements, it's like, I'm not going to bother to click through that story. I just look, okay, the macro is already bad. We're already seeing a major jump in money leaving banks and going to money markets and two-year notes. And it's classic fractional reserve bank contraction. It's just, you can't face it. It takes a while. And then I see that headline, okay, well, let's just throw gasoline in that fire. So I just don't, it's one of those things that also you have to also remember in this business. It's very important to focus on the forest of what you're looking at and ignore those little trees that'll knock you off your view. And that's what I see. The stock market's a pretty good tree lately, but it is actually, I think, aggravating my macro view that this is the biggest reset of a lifetime by keeping that Fed emboldened, by keeping those rate hikes still hanging on over our head, as so many other things are collapsing. And the people focus on the lagging things like unemployment. That's so not important. Let's look at the producer price index. The fact since 1948 it's never dropped as fast as it is now, and then I say that as a fact, should scare me. It should scare everyone. And what is being done to help alleviate that? Nothing. It's still going that. And the fact that we're having bank deposits on a year-over-year basis drop at the biggest, the highest rate in our database since the 50s. And what's out to stop that other than maybe just a pinprick every time one or two banks fall? Nothing. The macro's still bad. That's why I look at the big picture. You have to think at least 12 months forward. And that's where I'm still concerned that you see the Fed funds rate 12 months is still around 5%. And that's still restrictive because if I'm going to get 5% and guaranteed 10% in 2 years, why would I invest in any risk asset, particularly if you start rolling over it, cryptos have been doing.
McGlone cautions that there could be a major economic crisis on the way and advises people to be watchful in the next few months. He predicts that in the event of a severe global economic recession, Bitcoin is likely to outperform all other cryptocurrencies, which could signal a major shift for all other risk assets.
Treasury is the most leveraged market on the planet. You can get that financing for just about free. But to me, this is also part of the macro. Let's ask ourselves, can we not expect a reciprocal response to the biggest liquidity pump in history that's dumping at the greatest pace in history? And we've never raised rates this fast on a global basis. It's just logical, yet the market's already priced that, it's okay. But that's human nature. And you pile on. Like this analyst. Now, I love hearing these strategies when people say, yeah, but so-and-so said this. And I say, well, what's their vested interest? They have a vested interest in being right and selling you that crypto or selling you that stock market going up or the crude oil going up and being right? Or does it follow what they're paid to say these things? You hear these major strategies from major banks coming out with these bullish economic things. I'm like, that's the difference with me. I'm paid to be right. In the long term, it doesn't matter what I think. This is what the market thinks. The Fed is going to, and by July, there's a 55% chance they're going to raise rates another 25 basis points. It doesn't matter the exact percentage. The point is they're still tilting towards raising rates. Why? Because they're following inflation data that's very sticky. Personal consumption expenditures, employment cost indices, all driven by homeowners equivalent rent and things like that. That my economist Anna Wong says her models are saying they're supposed to start tilting towards cutting, but they can't because they're still following these lagging inflation metrics, which is the key thing that's part of the lose-lose from McGlone. It's very rare you'd ever see this, but they cannot ease with the ease they have until markets make them. Or we have this long delay, which would be wonderful. And that's where I think cryptos are starting to trickle down and saying, okay, guys, there's a problem. Collapsing commodities are pointing out clear deflation, but the Fed has to ignore that until their data shows we're okay.
McGlone believes that the Fed is far behind in its understanding of the market. He predicts that official acknowledgement of deflation is forthcoming, and the Fed will not ease with the same efficacy as in the past. Despite the potential challenges, McGlone remains bullish on Bitcoin, noting that it is defining itself as global digital collateral in the wake of the financial crisis. He sees the move towards fully collateralized crypto dollars as a positive development for the industry and suggests that Bitcoin is likely to be the best performer among cryptos in the coming years. McGlone's analysis suggests that the Fed's misunderstanding of the market and the impending economic crisis may provide a backdrop for Bitcoin's growth as a potential hedge against banking issues. What do you think about Mike McGlone's prediction for Bitcoin and the crypto market in 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is the Library of Wealth. We'll see you in the next video.